Get ready to find your recipe for a successful real estate lifestyle from America's top expert here at Greenlight REI with your host, Lance Edwards.
Well, hello everyone. Hi, this is Lance Edwards. Welcome to this edition of Greenlight REI, where we teach you the successful real estate lifestyle. We've got a special guest for today, a gentleman on a topic that I know you want to pay attention to, because it's going to be about cutting your taxes. I mean, substantially cutting your taxes. And here we are in the last final quarter of 2020 when this is being recorded. This is even how to cut your taxes this year, so pay attention. So with us today is Mr. Todd Strumpfer. Welcome, Todd.
Hey, Lance. Thanks for having me. I appreciate it.
Great to have you here, Todd. Todd is with Cost Segregation Services, Inc. He's been talking to us about depreciation and cost segregation, which may sound like a dry topic to some of you, but it will get your attention when you start hearing some of these numbers with regards to buying properties and owning real estate. So, Todd, I want to start. I'm just going to feed you some questions, and we're going to start off with the basics, and for everyone, if you don't mind.
Sure.
So let's start off. First of all, what is depreciation in the context of real estate?
Sure. And that's kind of my role, is just to kind of break things down into a simple. I'm not a CPA. I'm not an engineer. But yeah, hopefully I can break it down into easy to understand terminology here. So we're dealing with depreciation. So, for tax purposes, for business purposes, things depreciate, things wear out and lose value over time. And that's the same for buildings. So whether it's a commercial building or residential real estate like an apartment or duplex, of course, when you buy it, you're investing in it, you want it to appreciate or go up in value, and it typically does, and that's why you invest in it. But for tax purposes, the IRS allows for depreciation or wearing out. So parts and pieces in the building obviously do wear out, like your carpeting is an obvious example. So depreciation is a great thing. It's a non-cash expense. So as a business person, you don't like expenses all the time. You don't like spending the money, but at tax time, you like to have a big pile of expenses because that's going to lower your tax liability. And at that point, those expenses are a good thing. So as a non-cash expense, the beauty of that is you're not having to go down to Staples and buy a copier or pencils or anything else. You're not physically opening up your checkbook and spending money, but you get depreciation expense for your property. So the typical way to do it without cost segregation is called straight line depreciation. So in simple terms, you buy $1 million apartment, let's say. That $1 million would not include land. So you subtract land out, you're left with $1 million of building only. Your tax professional is going to take that and divide it by 27.5 years, which is the depreciable life for a residential rental property. Commercial property is 39 years. I don't know how they got those numbers, but that's what it is. So they'll take that $1 million that you paid for the apartment, net of land, and divide it by 27.5, and that's going to be your depreciation expense per year for 27.5 years. So that's without cost segregation. That's the depreciation you'd be looking at.
All right, so let's take that example. While you were explaining, I took my calculator. I took $1 million building divided by 27. Let's say it's a residential apartment. $1 million divided by 27.5 years. I got $36,363 is my depreciation expense, which is basically a deduction on my income tax return, right? Just a $36,000 expense that didn't cost me anything.
Correct. Right.
Okay. So let's just keep the math simple. If I was in a 30% tax bracket, multiply times 30%, that'd be $10,800 in tax savings.
Correct. Yep.
Okay. So that's straight line depreciation. All right. So now your business, Cost Segregation Services. So now you got to explain, what is cost segregation and why does anybody care about cost segregation?
Sure. And this has been around a while now, since actually the late 1990s. Cost segregation has been around, and way back when, people tell me it was called component depreciation or something different. But basically what happened were there were multiple businesses that argued that parts and pieces of their property wear out faster than 27.5 years or 39 years. So they should be able to depreciate parts and pieces, or what they call building components, depreciate those more rapidly. So it's been approved, and it's not a strange, crazy thing to do. It's done thousands of times every year. Our company, we've alone done over 20,000 cost segregation studies, and there's several companies that do what we do. So that's what cost segregation is the IRS allows you to depreciate parts and pieces of your property more rapidly, provided that you get a study done on your building. So what's going to happen is on paper, it's going to be broken out into all of its different parts and pieces or building components like carpeting. And some of those parts and pieces can depreciate over a 5-year life. Some can be in a 7-year life, some a 15-year life. And the rest, kind of the structural part of the building, will stay in a 27.5 or 39-year life. So typical building's going to have 50, 70, somewhere in that range, different parts and pieces that can be accelerated. And so you don't get more depreciation, you just get to bump maybe 20%, 30% of that forward and take that tax savings, take those expenses for depreciation now rather than waiting.
So an example I just used a moment ago, I took the $1 million example divided by 27.5. That was $36,000 a year deduction I would get on a straight line basis. If I now accelerate through cost segregation, the stuff with a shorter depreciation schedule, I could have a much bigger deduction. I could basically shift a bigger portion of the deduction into this year and subsequent years, correct?
Correct. So of that $1 million, you might get $200,000 or $300,000 of depreciation expense in your first year with cost segregation. And then again, take your tax rate, multiply it by that expense number, and that gives you the tax savings for you. So,
all right, so that's, go ahead.
People talk about the time value of money, so that's really what this is. What I like to use is, I don't play the lottery, but let's say you did, and let's say you win $1 million, and you have the choice of $1 million today or $25,000 a year for the next 40 years. Works better on a commercial property because that's a 39-year life. But anyway, $25,000 a year for the next 40 years or $1 million today. It's the same amount of money when you add it up, but a smart person would say, I'd rather have $1 million today because I can use it now rather than waiting.
You bet. Give me the cash. Give me the cash.
You bet.
All right. So that's cost segregation. Now there's a thing called 100% bonus depreciation. So now how does that layer on top of all this, Todd? Yep.
So cost segregation's always been great. Before there was 100% bonus, there was 50% bonus. So it was still excellent before. But what happened was the Tax Cuts and Jobs Act, or the Trump tax plan, people might call it. What that allowed for is any property purchased or built, so it doesn't matter if it's new or used, after September 27th of 2017 qualifies for 100% bonus depreciation. And I believe that's in effect until tax year 2023, so we've got a little while yet for that, and then it slowly phases out, and who knows, they might change that or re-up it or whatever. But what it means, before we had that, if we did a cost seg study the first year of ownership, the owner would get that tax benefit over the first 5 years that they owned it. So they'd get a nice benefit the first year, but they'd get more than the second, third, fourth, and they'd get the benefit over the first 5 years of ownership. Now with what they call 100% bonus depreciation, is any building component that we identify with a life of 20 years or less, and 20-year life, for those that care, it's ranch, kind of like farm property, but ranch property, so most of your clients aren't going to run into that. But so we're going to identify the 15-year life. By the way, that's going to be like parking lot, landscaping is 15-year life, exterior type things, 7-year life and 5-year life components. So anything with a life of 20 years or less gets pushed forward all the way to the very first year. So you don't have to wait even 5 years. You get it all pushed forward to the first year that you do cost segregation. So.
All right, so let's pause here. This is where it gets. This is the part you guys are going to like. Now, I have a number you gave me for my upcoming project. Do you have some typical numbers, what that means in terms of people's tax savings?
Yeah, the numbers that we use, and we always would get a free estimate, so there's no cost to see what the numbers look like for any particular situation. But as a rule of thumb, averages for every $1 million of building cost, the owner would likely save around $70,000 on their income taxes. So
okay,
that's the tax benefit, and that's not the depreciation expense increase or difference. So on a $500,000 building, they might save $35,000 on their income taxes, and it varies depending on the type of building. A hotel that's very ornate or has a lot of different parts and pieces in there is different than a self-storage that doesn't have a lot of parts and pieces in there. But both are great for cost seg.
All right, so let's make sure everybody got this, Todd. This is what I remember when you told me this. It got my attention. So this is $1 million building value. Building value is estimated $70,000 first year tax savings, not your deduction, less taxes you pay. It's like getting a check for $70,000 basically back from the government, or it's less $70,000 less you're going to pay Uncle Sam. And now let me ask you this. Let's just do some quick math, by the way, guys. Let's say you spent 20% down. Let's say you put $200,000 down on this property. So in the first year, you're getting $70,000 back. By my math, that's a 35% ROI in the first year, on your $200,000. Hello. I mean, this is just a beautiful thing. So let's play some what ifs here. Let's say, like I said, we're in 2020 recording this, Todd. I close on this property, for example, let's say on December 31st, 2020. How much of that, let's say this exact property, how much of that $70,000 tax savings do I get by closing the last day of the year?
You get all of the tax benefit. Yeah, believe it or not, day one, or get it by the end of the year, right? So that's what I understand. I don't know if I had a client close on the 31st of December, but yeah, I believe it's all pushed forward for you. It's
100%. And so that means, what that means, if you're listening, for those listening to this podcast here in the latter part of 2020, get to work. Go buy yourself a building between now and the end of the year and wipe out your taxes. Now, let's say, Todd, I had a question on this. Let's say somebody just bought $1 million building. They got a $70,000 a year tax savings, but they only paid $50,000, or they only owe $50,000 in taxes. What happens to the extra $20,000?
Yep. So most of our clients will take the benefit going forward. So $70,000 benefit, they only need $50,000, $20,000 rolls over to the next year. So they're not going to lose it. They get that to look forward to the next year. Something to check with their tax professional about, but with the CARES Act with COVID, there's a possibility if they're what's called a real estate professional, which is basically you're full-time involved with real estate, rather than take it going forward, you can actually go back if this creates a loss because they have more depreciation expense. It offsets, their income to the point where they've got a operating loss. They can actually go back in time, back 5 years, and move forward from there when they have paid in taxes, where they can actually get a physical check back. So that's something to talk to your tax professional about if you're a real estate professional, to look into that. Yeah.
So here's the challenge I'm going to put to everybody. Your challenge, if you're interested in buying real estate, apartments, whatever, given this, your purpose in life for everybody should be to now buy enough real estate to wipe out your tax bill for the next 5 years. That should be your challenge. Just because of 100% depreciation that could carry forward, just stack it up. Just stack it up. And right. I mean, the ROI on this alone justifies projects. As a matter of fact, I'm sure a lot of projects are justified almost exclusively on this benefit for high-income earners. All right. So you answer the question. Let's say, what about if I've owned a property since the date was September 27th, 2017. I bought it January 1, 2018. I didn't know about this 100% bonus depreciation. Can I now still take advantage of that, Todd?
Sure. Yep, that's a great question. So obviously a lot of people we talk to, they didn't know about this when they first purchased the building. So yep, we do that all the time. It doesn't have to be a new construction or a new purchase. We can go back in time for sure. And we do that every day. So what happens with those situations is maybe, let's say they purchased it in 2015. So they've already filed a return with that property for 5 years or 4 years right now. So there's called a 3115 form, change in accounting method form. So we would do the study just like we normally would, and that form is going to kind of catch them up to the depreciation they could have had if they had done cost segregation from the start. So we'll prepare that form after we prepare the cost segregation study, and then their tax professional will file that form 3115, and it's got a little box in there that catches them up with their depreciation. So yeah, we do that all the time. It's very common to do it on properties that have been owned even 10 years, 12 years. Once you get past 15 years, if you've done no improvements, because we can do cost seg on improvements as well. If they've owned it for 15 years, haven't really improved it, unless it's a multi-million-dollar purchase, it's probably depreciated past the point where we can really help much at that point. But they've owned it less than 15 years, it's worth getting. We get a free estimate no matter what. So there's no harm in checking what the numbers would look like.
All right, let's talk about that. So let's say a couple of things I'm thinking, Todd. So in order to claim this, you have to have a cost segregation study, right? That data needs to be fed to a CPA so he can do his calculations. And that's the business that you guys do, the cost segregation studies.
Yeah, I'll say what we sometimes run into is what I'll call accounting-based cost segregation versus what we do is engineering-based cost segregation. So I might talk to a building owner and they say, oh yeah, I think my CPA did that already. And what they did is maybe they pulled out, they know that carpeting is a 5-year life, and maybe they know X, Y, and Z can be 15-year life. So they maybe found 5 or 10% of the benefit that an engineering-based cost segregation study would do. So that's the difference there is, our engineers and analysts do this every day, all day long. So we're going to find a lot more benefit than your CPA just pulling out a few different building components and putting those on your depreciation schedule with a different life. So, and by the way, guys, I'm doing a project right now with Todd and his company. So somebody says, all right, well, first of all, I guess the first thing they can do, they can contact you and they can get an estimate of what you think you can do for them, right? Get other tax savings. Yep, real simple to do that. We just need basically what the use of the building is, how long they've owned it, what they paid for it. If they know the land cost, great. Otherwise, we'll take 20% out to account for land. So about a 24-hour turnaround once we have that information to get the free estimate for them.
All right, so then you come back with a proposal. Here's the cost. Here's what we're going to do for you. They sign up. So what's involved with the cost segregation study from the owner's standpoint? What do they need to be prepared for, Todd?
Yep, so we keep it pretty simple both for the owner and for their tax professional. What's involved would be a site survey, we call it, or we visit the property. What that's for is the IRS requires photos of the property. So we would go interior and exterior to get photos. Most properties takes 30, 45 minutes. It's not a real big deal. The owner doesn't have to be there. If they have a property manager that can be there, or even if just the tenant knows that we're going to show up, that's all we really need. So if they have had an appraisal done, we would gather that. If they don't have one, that's okay. Floor plan drawing or blueprints of the property, if available, we would gather. Sometimes the toughest part is to get that building, what we call building cost basis. So if they have a new purchase, they paid $1 million for it, but that includes land, they have to figure out how much of that $1 million is allocated to land. So their tax professional can help with that, or we can direct them to county records to figure that out. But we would have to get that number, the building cost basis without land. And that's about it. From that point, it takes around 6 weeks to get everything done.
All right. And so, of course, now, and one thing I will share with people is that, just like Todd said, cost segregation, componentizing, whatever you call it, it's been around for a long time. But in the past, for a small property owner, kind of, at least my view, maybe I was wrong, that the study cost was usually high, prohibited, the cost wasn't there. But what Todd's company has done has really, kind of a game changer from what I see in terms of lower that cost segregation study. I don't necessarily want to get into the cost of the studies now, but unless you want to, but what value of building do you probably need to have? What's the minimum value you would need to have to more or less justify the upfront cost of the study, Todd? What do you share and tell people there? Sure.
And I've been with the company for 11 years now, and when I first started, I'd hear a lot of building owners say, "Oh, my building's too small," and they've been told by other cost seg firms it has to be $1 million or more in order to make sense for cost seg. Maybe now it's more like 500 might be a cutoff for a lot of firms. Believe it or not, all the way down to about $150,000 because of 100% bonus depreciation, with that all getting pushed forward. So on $150,000, maybe it's a single family rental or a duplex.
Right.
The benefit might be $12,000 or $15,000 in tax savings. And our fee to do something like that, depending on when you see this video, might be around $2,000, something like that. So it's still cost effective for a smaller project. I'll mention too, we work with a lot of dentists or doctors that don't maybe own the building that they're in, but they lease the space, but they paid $150K or $200K to build it out the way that they want it. So we can do a cost seg study on the leasehold improvements as well. So something to think about.
Oh, is that right?
Yeah.
Oh, I didn't think about that. Okay. All right. So let's see. On a $150,000 building, I think what I heard is I put $2,000 in, and I get $12,000 to $15,000 back. All right. Let me put that in my calculator. Let me see. Does that make? Do I do that or not? My gosh, do those all day long.
Right.
All right. So in a moment here, I'm going to ask you to tell everybody how they reach you, Todd. So, but let me ask you a final question for you. What questions have I not asked that I should have asked you with regards to this topic?
Sure. Some people may wonder, or there may be cases where it just doesn't make sense. It is great. It is a wonderful thing. Reasons not to do it, basically two things. One is if maybe you just don't have the tax liability yet. Maybe it's a new business that you're starting or something like that. Maybe next year is a better time to look at it. But if you just don't have tax liability, then you don't need more expenses to offset that. The other reason is if you're maybe flipping a property. So if you want to buy a property in 2020 here and sell it in 6 months, probably not a good case for doing cost segregation because there's something called recapture, where basically you're giving back a lot of the benefit from cost seg once you do turn around and sell it. So rule of thumb we look at is if you think you're going to hold the property for 3 years or more, and you can always do a cost seg study and then decide next month you get a great offer and you want to sell it, that's fine. But financially, dollars and cents wise, our study fee versus the benefit and recapture factored in there, probably want to hold the property 3 years or more in order to get the most benefit from cost segregation.
Well, let me ask you, that's a follow-up question I have. If I sell it and do a 1031 exchange, does that not reset the basis and wipe out any recapture you might have?
That would help. You'd want to probably do a cost seg study on the new purchase as well to offset any downside. Right.
Well, good. It gives you perpetual income. It just keeps you.
Kind of does, yep.
Well, I'm just having a hard time imagining some situations somebody would not want to get a big chunk of cash, especially, and I agree, hold on to it for a few years. If you're just flipping in and out, yeah, but any kind of buy and hold person should be just lapping this up. And like I say, your objective should be to wipe out your tax bill for the next 5 years by buying enough property. All right, so Todd, how do they reach you? How do they get in contact with you and avail themselves of your services?
Sure. Would there be like notes? My email's
yes.
super long.
Yeah, I can put it in the show. There'll be show notes for this podcast. I can simply put it in the show notes.
Yeah, I could mention.
So you want to do it that way?
That'd be great. My email is todd.strumpfer@costsegregationservices.com. So if you can spell all that right, you're golden with that. My number is 888-303-4874, and that's my direct dial. Or email me, todd.strumpfer@costsegregationservices.com. I can give you my Gmail. My personal one is Todd Strumpfer@gmail. That's a little shorter. TODDSTRU, M as in Mary, P as in Peter, F as in Frank, ER. Todd Strumpfer@gmail is my personal. Feel free to use that as well.
All right, don't worry. Everybody, we're going to put this in the show notes so you can get access to all these. But really easy to work with, and to me, it's like a no-brainer if you're buying and holding property, which you should be. So, Todd, this has been excellent. I want to thank you for what you're doing for me on my projects. Thank you for your time today. Any final words of wisdom you might have for anybody as we wind down today?
No, like I say, we try to keep it real simple. So if you've got properties, you're not really sure, your tax professional may not have brought this up because they probably don't do engineering-based cost segregation unless they have engineers on staff to do it. So might as well get a free estimate, see what your numbers actually look like. From that point, we do a lot of conference calls with yourself, your tax professional, myself, and one of our tax people that can speak the language with your tax professional and get all the questions answered. So no harm in getting the numbers and seeing what they look like.
All right. Well, again, thank you. Thank you so much, Todd.
Thank you, Lance. Appreciate it. See you later.
All right, everyone. So this is Mr. Todd Strumpfer. If you got a property that you own now and getting ready to get in touch with Todd, let him give you an estimate what you can save in taxes. At minimum, get him in your Rolodex so when your next purchase, you can get those cost segregation, get all the depreciation, 100% bonus depreciation credits, and it's 100% bonus depreciation, I think, until January 1 of 2023. So you got a little bit of a window here to buy up some property. So with that, thank you for joining today's episode. Go check out the show notes. Go get access to Todd's information, see the other free resources we have available to you. And until the next time, make it a successful real estate lifestyle. Take care, everyone. Bye-bye.
You've been listening to The Expert with Lance Edwards. Let us now blatantly and shamelessly bribe you toward creating your own real estate lifestyle by offering you a whole bunch of free stuff. Go to greenlightreinvesting.com and get you some free stuff and this session's show notes.